The most expensive tax mistake Americans make isn't cheating, it's being patient. There is a retired engineer in Tennessee who received a $41,000 federal tax bill in 2023, his second year of retirement. He hadn't sold any investments. He hadn't made unusual income. He was pulling Social Security and taking court-ordered withdrawals from his 401k that the IRS mandates starting at age 73. He had no say in the income. The government handed him the bill anyway. And here's what makes it genuinely painful to think about. At 62, there was a completely legal strategy on the table that would have eliminated most of that bill permanently. Nobody told him the clock was running. He waited. The clock ran. Now multiply that single bill by the 22 years he has left on an actuarial table. You're not looking at $41,000 anymore. But here's what's different about 2026. And this is the specific layer nobody is covering right now. Not on other channels, not in the planning offices, not in any retirement calculator you've ever found online. The window to fix this problem is not 5 or 10 years wide. It is 2 to 4 years wide. And it is closing from both sides simultaneously because of two competing forces that have never existed at the same time in the history of American tax law. If you are between 60 and 67 and you have a significant balance in a 401k or traditional IRA, this is the most important tax math of your retirement. I'm going to show you the whole picture. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use static tax assumptions that are already out of date, and they completely ignore what happens to your Social Security taxation as your income rises. Mine uses BlackRock and Vanguard modeling logic to expose the actual weak points in your plan. I only ask for your email to send the report. I don't store any of your financial data. Link is in the description. Here is the mental model I want you to carry through this entire video. Imagine you spent 20 years building a business. On day one, without fully reading the contract, you signed a partnership agreement with a silent partner. He contributed $0. He showed up to 0 meetings. He did 0 work. But the contract says that when you eventually start pulling profits out, he gets a cut. How big a cut? Here's the strange part. The contract doesn't say. It reads, cut to be determined at the time of distribution based on prevailing rates. You don't know his percentage today. He sets it later. And there's one more clause you almost certainly missed. He gets to decide when you start pulling profits out, not you, him. Starting at a date he chose, you are required to distribute earnings whether you want to or not. That is your 401k. That is your traditional IRA. The federal government is your silent partner. He contributed nothing. He watched your money grow tax deferred for decades. And now, starting at age 73 under current law, he sends you a document called a required minimum distribution schedule, tells you exactly how much you must withdraw each year, and taxes every dollar of it as ordinary income at whatever rate he has decided is appropriate at that time. A Roth conversion is one specific thing. It is buying out the silent partner. You pay his share today at today's rates, and from that point forward, the account is entirely yours. No future forced withdrawals. No future tax bills on the growth. No partner. The money compounds. You access it whenever you choose. And when you pass it to your kids, they access it with no tax liability either. The question is never whether to buy him out. The question is always, at what price? Right now, that price is at a generational low. And the conditions that created that discount are actively, measurably deteriorating from 2 directions at once. In a few minutes, I'm going to show you exactly why the planning software your financial advisor uses to model your conversion timeline is almost certainly producing the wrong answer and why that error could cost your household hundreds of thousands of dollars. But before that, here's why the starting assumption most people carry into retirement is wrong in a way that genuinely changes everything downstream. The assumption is this: I earn less in retirement, therefore I pay less in taxes. It sounds airtight. You stopped working, your salary disappeared, your income dropped, taxes follow. It is one of the most confident beliefs I hear from otherwise sharp people who built careers, ran companies, raised families, and accumulated real wealth. And in almost every case above a certain account balance, it is catastrophically wrong. Here's what actually happens. You retire. Maybe you have a pension that's income. You hit 62, 65, 67, you turn on Social Security, more income. Then you hit 73, and your 401k, which has been sitting there quietly doubling every 10 years on average, generates required minimum distributions. The IRS calculates your annual mandatory withdrawal using a life expectancy table. The formula becomes more aggressive every year you're alive because the denominator, your projected remaining life, keeps shrinking. Real numbers. A couple retires at 62 with $1.5 million combined across their 401k accounts. They do nothing. They let it grow. Assume 6.5% annual growth conservative for a balanced portfolio across a decade. By age 73, that $1.5 million has become approximately $2.9 million. The IRS life expectancy factor at 73 is 26.5 required minimum distribution in year one, approximately $109,000. They don't need that money. They have Social Security. They're fine, but they must withdraw it. They must report it. They must pay taxes on all of it. Add Social Security. $60,000 combined for a couple who waited to claim at full retirement age. Total reported income, $169,000 in retirement without earning a dollar. That is deep inside the 22% federal bracket, heading toward 24. And the RMD grows every single year because the account is still compounding while the life expectancy denominator keeps falling. By age 80, that couple's annual required minimum distribution alone can exceed $150,000. They came into retirement thinking they'd live on 12 or 15%. They're looking at an effective rate on retirement income that rivals what they paid at the peak of their careers. The silent partner didn't charge a one-time fee. He set up an escalating payment schedule and handed you the calendar. I want to introduce someone here. His name is Frank. He spent 34 years in manufacturing project management in Ohio. He did everything right. Maxed his 401k starting in his early 30s. Good marriage, 2 kids. He retired at 65 and has $1.8 million sitting in his IRA. His financial advisor mentioned Roth conversions at a review meeting about 2 years back. Frank said, "Let me get settled first." He started Social Security at 66 because the break-even calculation seemed to justify it. He's 67 now. He's settled. I'm going to come back to Frank. Now, here is what gets really interesting. And this is the part where the software your advisor runs, the same platform modeling your 20-year gradual conversion, is showing you a picture that is almost certainly based on the wrong inputs. In 2017, Congress passed the Tax Cuts and Jobs Act. Individual income tax rates were reduced across every bracket. The top marginal rate dropped from 39.6% to 37%. The 25% bracket became 22%. The 28% bracket became 24%. The standard deduction for a married couple filing jointly roughly doubled from about $12,400 to what is now $30,000 in 2025. These were real, meaningful reductions for most American households. What was buried in the legislation's structure, every single individual tax provision in the Tax Cuts and Jobs Act had an automatic expiration date built in, December 31st, 2025. Congress structured it this way to limit the official 10-year budget cost and get the bill through the reconciliation process. The cuts were always written as temporary. That is not a conspiracy. That is how the vote math worked. And as of the day I'm recording this, Congress has not made them permanent. There is active legislation moving, and you have probably watched the news coverage of it, but it has not passed. Any version that extends or makes permanent these cuts adds an estimated $3 to $5 trillion to the national debt over the next decade, depending on whose model you use. Which brings us to the second force. In May of 2025, Moody's downgraded the United States government's credit rating. If you saw the headline and moved on, here is what you may have missed about the context. That downgrade means that for the first time in the history of the United States, all 3 major credit rating agencies, Moody's, S&P, and Fitch, have now all removed their pristine AAA designation from the US government. S&P downgraded in 2011. Fitch followed in 2023. Moody's was the last holdout, and they held out until May 2025. Now all 3 are aligned. That has never happened. Not during 2 world wars, not during the Great Depression, not during 2008. Not ever. The national debt is currently approximately $36 trillion. The annual interest payment on that debt now exceeds $1 trillion per year, larger than the defense budget, larger than Medicare, larger than Medicaid. The interest alone. And the Wharton School at the University of Pennsylvania, not a fringe institution, one of the most rigorously quantitative economic research programs in the country, has published modeling suggesting that stabilizing the US debt to GDP ratio would require roughly a 33% immediate permanent increase in effective federal tax rates. 33%. We were there 45 years ago, back in 1980, back in the early Reagan years. Effective tax rates on American households were 33% higher than they are today. What we are living inside right now is a historical anomaly, a generational low-tax environment built entirely on borrowed money, currently being extended with more borrowed money, and every borrowed dollar is a tax deferred into the future. The pattern should feel familiar by now. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may literally never show you my videos again. I put significant research time into these, and the algorithm doesn't surface channels. It doesn't see real engagement on. One click changes my reach considerably. So here is the full picture. On one side, the most favorable individual tax environment in a generation, either already expired or being preserved on a debt-funded extension of uncertain duration. On the other side, a fiscal crisis that the Congressional Budget Office, the Wharton School, Moody's, S&P, and Fitch are all independently characterizing as requiring higher revenue. These two forces are pulling in opposite directions. The gap between them is the hidden Roth conversion window. It is 2 to 4 years wide, maybe narrower depending on the legislative calendar. Your financial advisor's software doesn't know about the gap. It models a flat or modestly increasing tax environment for the next 20 years because that is the actuarially safe assumption. It was not programmed to price in what happens to tax rates when the federal government is refinancing $36 trillion at current interest rates, has 3 credit downgrades from 3 separate agencies, and faces political extinction if it cuts Social Security or Medicare. So when the software says, take your time, run a 20-year gradual conversion starting at 65, it is solving the right problem with inputs that do not reflect the current structural reality. You are the one who absorbs that error. The silent partner's buyout price is at a historic discount. That discount has a structural expiration date. This is the window. This is the thesis. Now, here is what most people assume is the core retirement tax problem when they hear about it. They think brackets. They think about their marginal rate, 22%, 24%. That's the number they focus on. That feels like the problem to solve. It is not the biggest problem. The biggest problem in retirement taxes is something called provisional income and the way it interacts with Social Security. And it has been quietly running in the background since a law Congress passed in 1983 that almost no advisor proactively explains. Here's how it works. When Social Security was built, only higher income retirees paid tax on their benefits. Congress set income thresholds below which benefits were completely tax-free. Above $25,000 of combined income for single filers, $32,000 for married couples, up to 50% of Social Security benefits became taxable. Above $34,000 single, $44,000 married, up to 85% became taxable. Those thresholds were set in 1983. They have never been adjusted for inflation, not once in 42 years. A threshold designed to target only high-income earners now captures the vast majority of middle-class retirees because the thresholds are frozen in 1983 dollars, while income, even retirement income, has been growing with inflation for 4 decades. And here is where it crashes into the 401k problem in a way that creates a genuine feedback loop. Required minimum distributions count as ordinary income. They push your adjusted gross income up. Provisional income is your adjusted gross income plus half your Social Security benefit. So when your RMD pushes your income up, it also pushes more of your Social Security into taxable territory. More taxable Social Security increases your income, which could push you into a higher bracket, which increases the effective tax rate on your RMD. It is self-reinforcing once it starts. Run the numbers on our couple from earlier. They're 73. RMD is $109,000. Social Security is $60,000 combined. Half of that Social Security is $30,000. Total provisional income, $139,000. They cleared the $44,000 married threshold before the end of January. 85% of their Social Security, $51,000, is now taxable income. They did not earn it in any traditional sense. They did not choose to have it on their tax return. It is there because of a formula Congress wrote when the average American had never heard the word internet. Roth distributions are not included in provisional income. Zero weight. They do not exist for this calculation. The couple who did systematic conversions between 62 and 68 before Social Security, before RMDs, they arrive at 73 with a fundamentally different tax return. Their RMDs are dramatically smaller because a significant portion of their savings already lives in Roth accounts. Their provisional income stays below or near the threshold. $30,000, $40,000, $50,000 of Social Security that would have been taxable is not every year for the rest of their lives. That is not the silent partner charging a lower rate. That is the silent partner leaving the room entirely. There's one more mechanism in the same category worth knowing about because almost nobody mentions it. It's called IRMAA, Income-Related Monthly Adjustment Amount for Medicare. If your modified adjusted gross income exceeds certain thresholds, your Medicare Part B and Part D premiums include income-based surcharges. For a married couple filing jointly in 2025, those surcharges begin above $212,000 and can add several hundred to well over $4,000 per person per year in additional premium costs per person. And these surcharges are evaluated using your income from 2 years prior. So a single large RMD in your early 70s can spike your Medicare costs in your mid 70s long after you've forgotten what caused it. Roth distributions don't trigger IRMAA because they're not included in the modified adjusted gross income calculation for that purpose. The silent partner buyout eliminates a cascade of secondary costs that most planning software treats as background variables rather than controllable outcomes. Back to Frank. He started Social Security last year at 66. His provisional income is already near the $44,000 threshold. The conversion is still available to him technically, but every dollar he converts now lands on top of existing income, potentially making more Social Security taxable, potentially triggering IRMAA in 2 years. The mathematical window is narrower than a mail slot, where at 62 it was a double door. He has room for partial conversions. He will do them. He will save something meaningful, not what was available to him 5 years ago. Frank's situation isn't a disaster. Frank's situation is a what if that I want to install in the mind of anyone watching this who is 61, 63, 65, whose window is still wide now. Here is what nobody is telling you. And this is the piece that quietly dismantles wealth families spent decades accumulating in families who believed they planned carefully. The Secure Act of 2019 changed the rules for inherited retirement accounts in a way that most Americans still haven't fully absorbed, partly because the IRS's final regulations took several years to confirm. Before this law, when you died and left your traditional IRA to an adult child, they could stretch distributions over their own lifetime. Pull a modest amount each year, let the rest compound, minimize the annual tax hit across decades. It was a genuine wealth transfer mechanism. The Secure Act ended it for most non-spouse beneficiaries. Under current law, most adult children who inherit an IRA must completely drain the account within 10 years of inheriting it. No stretching, no lifetime distributions, 10 years, full stop. Walk through what that means in practice. You pass away at 82 with $750,000 remaining in a traditional IRA. Your 54-year-old son inherits it. He has a good career. He's in his peak earning years. He must drain that account within a decade. $750,000 layered on top of his existing salary over 10 years. The IRS treats every dollar as ordinary income in the year he withdraws it. He might be paying 24% on most of it. He might be paying 32%. If effective tax rates are 33% higher in the 2040s, which, based on everything I just showed you, is not an irrational projection, the number gets considerably worse. Your silent partner, who contributed nothing to your financial life, is presenting his invoice to your son. If that account was a Roth IRA, your son still has to empty it within 10 years. Same rule, same timeline. But every dollar comes out with zero federal tax. The silent partner was bought out years ago at the historically discounted rate and has no further claim on anything in that account. The difference in a case like that can be $150,000 to $350,000 going to your family instead of the Treasury. At today's rates, if rates normalize upward by the time your children are pulling that money out, the figure grows proportionally. And a state attorney I heard about 27 years of practice, primarily retirement-age clients in the Southwest, said something to a colleague that stuck with me. She said the most consistent sentiment she witnessed at estate settlement meetings was not, "I wish we'd invested differently." It was some version of, "I had no idea the government had a claim on what we were." Leaving the kids. The investment decisions, people understood. They'd watched the account for 30 years. The tax architecture of the inheritance, that part was always invisible until the table was set and it was too late to renegotiate. It is never invisible at the settlement table. Let me give you the full case study, because this needs to stop being abstract. David is 62, 28 years in regional sales management for a medical device manufacturer. Susan is 61, 22 years in hospital administration. Combined 401k balance, $1.5 million. They plan to work until 65. Neither has claimed Social Security. One daughter, age 34, works in marketing. They have $200,000 in a separate taxable brokerage account outside of retirement accounts. Their home is paid off. In the no conversion scenario, they retire at 65. The 401k, growing at 6.5% for 3 additional years, reaches approximately $1.8 million. They live on Social Security and brokerage distributions for 8 years. At 73, RMDs begin on a balance that has grown to approximately $2.9 million. Year 1, RMD, $109,000. Combined, Social Security, $64,000. Provisional income calculation pushes 85% of their Social Security, $54,400, into taxable territory. Total taxable income in year 1 of RMDs, approximately $163,000. Bracket, 22 to 24% today, likely higher if TCJA has fully or partially reverted. This escalates every year. When they pass, their daughter inherits a traditional IRA with a significant balance. She spends a decade grinding it into her peak career income at whatever rates exist in the 2040s. In the systematic conversion scenario, starting at 62, they work with a CPA who is also building their retirement income projection, not 2 separate professionals in different offices who have never compared notes. Each year, they calculate their current taxable income and identify how much room remains before the next bracket ceiling. They convert $120,000 to $140,000 annually, filling the 22% bracket completely, stopping at the threshold. Critically, they pay the conversion tax from the $200,000 in their brokerage account, not from the converted funds themselves. This ensures every dollar converted moves into the Roth intact. Over 5 years, they move roughly $650,000 to $700,000 into Roth accounts. They retire at 65 with a traditional IRA holding approximately $900,000 instead of $1.8 million. At 73, the remaining traditional IRA has grown to approximately $1.5 million. Year 1 RMD, $57,000. Combined Social Security, $64,000. Provisional income, $89,000. Total taxable income, roughly $115,000. A significantly lower bracket. IRMAA surcharges are not triggered. Their daughter inherits a substantial Roth IRA. She empties it over 10 years. Tax liability on the inheritance, 0. Total difference across their lifetimes. And their daughter's, a properly modeled projection, lands somewhere around $635,000. That estimate uses today's tax rates It does not assume any increase. It does not price in the IRMAA savings. It does not fully model the compounding impact on tax-free growth in the Roth over the daughter's lifetime. The real number, with realistic tax rate normalization built in, is almost certainly larger. $635,000, not from a better stock picker, not from timing the market, from understanding which account the money lives in, from buying out the silent partner before the price went up. There's a structural reason most people miss this entirely, and I want to name it because it explains Frank, and explains the Tennessee engineer, and explains the estate settlement table. Your financial advisor, and I say this without malice, because I have spent years working alongside people in this profession, typically does not file tax returns. Not for clients, often not for himself. Think about that for a second. The person designing a tax optimization strategy for your 30-year retirement has his personal return done by someone else every April. He understands portfolios, he models growth rates. He is not the person who wakes up at 2 in the morning thinking about your income trajectory at age 79. Your CPA, and again, no malice, these are skilled professionals doing important work, is excellent at compliance. She keeps you out of trouble with the IRS, files accurately, finds the deductions you'd miss. She is not, in most cases, building multi-decade retirement income projections or modeling what your 401k does to your Social Security taxation over 20 years. These are two different jobs. The tragedy of American retirement planning is that the person who understands your taxes doesn't know your portfolio, and the person who knows your portfolio doesn't understand your taxes. They have never been in the same room for your benefit. Wait, so my advisor and my CPA have been in separate offices for 15 years and nobody suggested they might want to talk to each other? That is a correct summary of how most American retirement planning works. You have been paying 2 sets of fees for 2 parallel half pictures. The couple who saved $635,000 is not smarter than their neighbor. They found someone who brought both halves into the same frame at the same time. That's the entire edge. 10+ years running my own business and being surrounded by accountants and tax attorneys taught me one thing above everything else. The money doesn't move on the investment side. It moves at the intersection of investment decisions and tax architecture. Most people never see that intersection because they've hired 2 separate professionals who are each standing on one side of it. Now, the 2 questions I promised at the start of this video. These are the questions I have started asking people at business meetings, at dinners, anytime I'm talking to someone in their 60s with a significant account balance. 95% of them cannot answer either one, and both answers are knowable with the right modeling. First question, what is your estimated marginal tax rate at age 80? Not right now, not when you retire. At age 80? Because that is when your 401k has been compounding for 7 years past the start of your RMDs. Your mandatory distributions are at their highest. Your provisional income has been dragging your Social Security into taxable territory for nearly a decade. And the federal tax environment may look very different from today's. If you do not have that number, you are navigating the most financially consequential phase of your life without the most basic piece of information. Second question. How much across your lifetime and your beneficiaries' lifetimes could a properly executed Roth conversion strategy save? Not, should I consider a conversion? For most people in this situation, the structural answer to that question is clear. The relevant question is the size of the opportunity, because the size determines urgency, and urgency determines whether you act inside the window or watch it close. Get those 2 numbers. From a CPA who is actively modeling your retirement income projection, not your current year return. Pull the projected tax return at 73 with no conversion and compare it to the same projection with systematic conversion built in. The difference will either create urgency or confirm you're in a good position. Either outcome is useful. The ambiguity is what costs money. One more thing to be clear about, because the wrong version of this advice creates real damage. Do not watch this video and immediately convert your entire 401k balance. That is not the strategy. If you convert an oversized amount in a single year, you push yourself into a higher bracket, potentially trigger IRMAA surcharges, potentially make more Social Security taxable, and undo a significant portion of the benefit. Systematic conversion means filling bracket space surgically, stop at the ceiling, come back next year, repeat over several years. And the conversion is typically the final piece of the retirement planning puzzle, not the first. Social Security, filing optimization, income strategy, estate structure, long-term care, those come first. The conversion slots in once the full architecture is visible. People who get burned are the ones who converted a large sum in a single year without modeling the cascade effects. Back to Frank. He is 67. His window is narrowing. He is going to do partial conversions over the next 2 or 3 years, whatever bracket space he has, before RMDs arrive at 73. He will save something meaningful, not what was available at 62, before Social Security, before the provisional income threshold was in play. His daughter will inherit some traditional IRA and some Roth. It is not the outcome he'd have had with better timing. It is considerably better than doing nothing. Frank's story doesn't end in a disaster. Frank's story ends in a conversation with his CPA that starts with, "I should have had this meeting 5 years ago." That is a better outcome than most. It is a worse outcome than the one that was available. The window is open. 2026, possibly 2027, maybe 2028 if the legislative extension holds. Tax rates at generational lows. Debt at historic highs. Credit agencies flashing red in unison for the first time in the country's history. $3 trillion of additional obligations attached to the legislation that's supposed to preserve today's rates. The silent partner's buyout price has never been this low, and the structural forces that created this discount are actively unwinding. 3 things to do this week, not this year, this week. First, pull your most recent 401k and IRA statements and add them together. If you are between 60 and 67 and the combined total exceeds $500,000, you are in the window where this math potentially applies to your situation in a meaningful way. No more ambiguity about relevance. Second, ask your CPA, not your financial advisor, your CPA, to model your projected tax return at age 73, assuming your current balance grows at 6% annually until then with no withdrawals before RMDs. Ask specifically how much of your Social Security will be taxable at that income level. Most people who run this exercise for the first time react with genuine surprise. That reaction ends the ambiguity and starts the productive conversation. Third, before converting a single dollar, build the full picture first. Social Security filing strategy, income sources, and timing. Estate structure, long-term care. Conversion fills in last. The people who do this right bring the CPA and the retirement income planner into the same conversation before any action is taken. The integration is where the $635,000 difference lives, not in any individual piece of the strategy, but in how all the pieces interact. The window is open. The silent partner is offering a historical discount. The forces that created that discount are measurably unwinding. Your 401k is sitting there, growing, with his name still on part of it. Lazy investing built more fortune than crypto memes. And a boring, spreadsheet-driven, CPA-approved Roth conversion strategy executed between 60 and 67 will generate more durable family wealth than every investment trend that has come across your social media feed in the last 5 years. The window is open. The price is historically low. He won't be this cheap forever.